So you want to invest in the global economy. I mean, where do you even begin? You've got literally thousands of companies spread across dozens of countries. It can feel, well, a little overwhelming. But what if I told you there was a way to buy a piece of the world's biggest and best companies, all in one go? That's where this thing called an ETF comes into play. Let's dig in.
And hey, this isn't some hypothetical question. This is the real deal for so many investors. How in the world do you get that broad global exposure without having to go out and buy over 1,000 individual stocks? Well, today, we're going to look at one of the most popular answers to that exact problem.
For a whole lot of people, the solution is an exchange-traded fund, or ETF, that goes by the ticker symbol IWDA. You can think of it as a simple go-to foundation for building a long-term global investment portfolio.
Now, the full, kind of fancy name is the iShares Core MSCI World UCITF ETF. It's run by iShares, which is a part of BlackRock, one of the absolute biggest asset managers on the entire planet. And that UCITS part you see, that's actually really important. It's a European regulatory standard, which basically means it comes with some strong protections for investors. So yeah, this is no small-time product, it's a real heavyweight. And just in case you're new to all this, let's quickly break down what an ETF even is. The easiest way to think about it is like a shopping basket. It's a basket that you can buy and sell on the stock exchange, just like a single stock. But instead of holding one thing, this basket holds a whole collection of assets. In this case, hundreds and hundreds of stocks from different companies. And we are not talking about a small basket here. The IWDA fund has over 100 billion euros worth of assets inside it. To put that into perspective, that's bigger than the entire economy of a lot of countries. That scale alone just tells you how popular and trusted this thing is for investors all over the globe. Okay, but what's it going to cost you? Well, the annual fee, or what they call the total expense ratio, is just 0.20%. So for every $10,000 you put in, you're paying just $20 a year in fees. For the kind of diversification you're getting, that is incredibly cheap.
Right, so we know it's huge and we know it's cheap. But the big question remains, what's actually inside? When you buy one share of IWDA, what companies, what countries are you actually getting a piece of? Let's pop the hood and take a look.
Here's the secret. IWDA doesn't have a team of geniuses trying to pick winning stocks. Nope. Its one and only job is to perfectly copy a pre-made shopping list. In the world of finance, we call that list an index. And the specific one it follows is called the MSCI World Index. You really gotta get this part. The MSCI World Index is the recipe. It's the blueprint that IWDA follows to the letter. It's designed to capture about 85% of the stock market value in all 23 of the countries it covers. It's a massive snapshot of the developed world's economy. And what countries are we talking about here? Well, you've got the giants, of course, the US, Japan. You've got the big European players like the UK, France, and Germany, plus others like Canada and Australia. But notice that keyword, developed markets. Keep that in the back of your mind because we're going to come back to it. And it's not just countries, you're also spread across different industries. But, and this is a big but, it is not an even split, not by a long shot. Just look at that huge slice for information technology. It makes up more than a quarter of the entire index, followed by other big sectors like financials and healthcare. So which companies pull the most weight? Because the index is weighted by company size. The bigger the company, the bigger its slice of the pie. The names at the top are going to look very familiar. We're talking NVIDIA, Apple, Microsoft, Amazon, Google. These are the titans. In fact, these top 10 companies alone make up a really significant chunk of the whole fund. Okay, so now we know what's inside. We've seen the ingredients, so let's get to the why. Why have millions of investors decided to make this particular ETF a cornerstone of their financial future? What are the big advantages? It really boils down to three main things. First, you get instant diversification. In one click, you're spreading your risk across over 1,000 companies in 23 different countries. Second, like we saw, the cost is super low. And third, and this is a huge one, IWDA is an accumulating fund. That means any dividends paid out by companies like Apple or Microsoft aren't sent to you as cash. Instead, they're automatically reinvested to buy more shares, which helps fuel that beautiful snowball effect of long-term compounding growth. But there is another secret weapon here, and it's a big one, especially if you're investing from outside the US. Because IWDA is based in Ireland, it gets a special tax treaty with the United States.
And what that means is the tax on dividends you get from all those US companies is cut in half, from 30% down to just 15%. Over decades of investing, that tax saving can make an absolutely massive difference to your final returns.
All right, it can't all be sunshine and roses, right? Every single investment has its own risks and its own limitations. So to give you the complete picture, we need to talk about what IWDA doesn't do and where its biggest blind spots are.
And this is probably the biggest thing to be aware of. Even though it's called the World Index, its fate is overwhelmingly tied to just one country. A whopping 72% of the fund is invested in US companies. So what does that mean? It means if the US stock market has a really bad year, this fund is going to feel it in a big way, no matter how well Japan or Europe might be doing.
And remember what I said earlier about the word developed? Well, here's what's missing. The MSCI World Index completely leaves out what we call emerging markets. That means you get zero, zilch, nada exposure to massive, fast-growing economies like China, India, and Brazil. That's the key difference between this index and an even broader one like the MSCI ACWI, which stands for All Country World Index.
And this quote from EasyVest really just sums it all up perfectly. The MSCI World Index and the IWDA fund that tracks it is a fantastic, solid foundation. It's a simple, super efficient way to own the developed world. But it is not the entire world. So what's the bottom line? IWDI is an incredibly powerful and simple tool. It gives you a huge piece of the global economic pie for a very low cost. But it also leaves us with one final, really big question to think about. As the world's economic center of gravity continues to shift, will investing only in today's developed markets be enough to capture the real growth of tomorrow?